Good morning, good afternoon, good evening, whatever time you're watching this, whenever you're watching this, wherever you're watching this. I'm Matt Gouget. I've got my buddy Nash Paradise, the Loan Wizard, the Nostradamus of all things real estate and mortgage related. We'll get more into that later. Some great foresight and predictions from Nash that seem to have came true. But we're here again on a Monday, going through market data, economic news, how it affects mortgage, how it affects the real estate market, and doing all the work to compile this data so that you don't have to go out there and search it up on your own. And then, in my opinion, the most important part, giving you a real how does it affect me, real world implications of all this different stuff that we're tracking. So without further ado, Mr. Nash Paradise, how the heck you doing?
Doing good, man. Always nice to come in on a Monday and see that we've had a good week. And by good week, I mean good for us. That's why we're here. We want things to look good. So let's jump in and talk about why. Let's get into last week's news. Oh man, there's so much stuff. It's really hard to see. Don't worry. I'll summarize this for you. Last week, a couple important moves. We had Powell doing his testimony. Cool. A lot of the same, but we also had speeches from Williams, Collins, Barr, Schmid. A lot of the members of the Fed coming in hot, basically saying, yeah, this stuff needs to come down. We're probably coming down. They're concerned with both employment and inflation, but right now, inflation is kind of the hot button item. So watching that come down, pretty cool. End of the week last week. Thursday was jobs day. We had jobless claims, continued claims, durable goods, and everything was pretty close except durable goods. Durable goods was kind of wild. Previous month was a negative 6.3% on the pricing, and this month was a positive 16.4%. And the neat thing there, it's just neat. It didn't necessarily move the needle on anything, but to miss that far was pretty crazy, pretty wild. Jobless claims, though, and continued claims were all pretty flat. GDP, relatively flat, compared to estimates. Everything was fine, but it's moving in the right direction. And we talk a lot about how as soon as we get moving in a direction, if everything stays fairly consistent with that direction, the markets move in anticipation, not in necessarily reaction. So the way things are going, they begin a lot better because we've been hitting the numbers we expect. Let's jump slides here and talk about what we are queuing up for this week. I think the nice thing is, as we have kind of turned this corner into Treasury bond yields dropping, into interest rates dropping a little bit, I feel like we're set to ride this wave for a while, as long as nothing jumps up and messes things around. ISM manufacturing tomorrow, that's pretty important. We had last month, this month, the same projection, so that should be pretty clear. Thursday is the big day, though. I don't like the fact that Thursday is right before a holiday. Anytime you get some bad news before a 3-day weekend, it tends to be overreaction time. But that's non-farm payrolls, unemployment rate, and S&P Global Services PMI. The one to watch here is really the non-farm payrolls. The projection is 110,000, and last time it was 100, or the last figures were 139,000. So we're projecting to add a lot fewer jobs in June. If we miss on that and there's a bunch more jobs added, we could see rates react negatively. And so my, hey, watch out this week kind of day is Thursday. Get your stuff in beforehand. You don't ever want to take a float into, the last day before a 3-day weekend. It's just not a good time. Your thoughts on this week's stuff?
Yeah, I just wanted to kind of reiterate what you said about, overreaction and a 3-day weekend. Generally speaking, if there's something that's, in this case, going to negatively impact mortgage bonds, what you would normally see if Friday wasn't a holiday is the reaction. And in the case where, just to be safe, it might move more than it has to, Friday you would get that bounce back. Well, there's no bounce back because markets are closed Friday. So to your point, if lenders, have a repricing for the worse for mortgage rates, you don't want to be on the wrong side of that. So I'm sure, you said it without saying it, you're locking stuff that you get in early this week, before any of that Thursday data comes out. And then the lenders just, price accordingly. And if it's bad for rates, they're gonna have a buffer built in as well because Friday's a holiday. So you're gonna see, in my opinion, an extra 10 or 20 basis points to account for risk. So get beforehand, lock them up. No reason to wait, especially if you got something closing in the next 30 days.
No, and markets close at 2 on Thursday. So you're really jamming a lot of content, a lot of data in there at a time period where most consumers don't care. No one is sitting here Thursday and being like, hey, I wonder what the jobless claims are, except for me and you, because it's fun for us. But everyone's getting ready for the holiday weekend, celebrating some America, getting their freedom fries on, hang out at the Gulf of America, do some vacation, because that's what we do here in Texas. We go down and drive like 9 hours to actually see water. I don't want to hear about what you get to do there in California, but it's not going to be on everyone's priority list. So, get your business done by Wednesday and have yourself a good time. Speaking of good time, here's where I get to brag on myself and my Nostradamus as we move on through to the next slide. There we go. Now, I love this. So what did I say last week? Hey, if we get some good stuff after the Fed meeting, we get some good interviews, Powell is Powell, we could possibly see a forecast of 3 rate drops this year. What do we have here? Rate drop on September, rate drop in October, and a rate drop in December. Now, is this certainty? Absolutely not. We've gone back and forth from 5 drops to 0 drops to 2 drops, now to 3 drops. And okay, cool. We're moving this direction. I do feel like I wouldn't be shocked if July 30th, I mean, that's a long time away. We get a full month between now and July 30th. We've already moved from almost no chance of a drop in July to now 19%. If we can push up to that 40, 50% mark, I think it could be interesting. If nothing else, it's going to be something to talk about. Like, hey, will the Fed drop rates in July? What does that mean? So all you real estate agents, mortgage loan officers who are paying attention to watching this podcast, keep that in mind as a talking point because it could get interesting. But without a doubt, by the time we get to September, we're going to have that first drop if we haven't already. The interesting new stuff that we have here, we were not previously projecting a drop in October. Now we are. And then that December is still, it's 64-36, basically. More likely than not right now, projecting a third drop. Before it was as late as like March of 26. Then we bumped up to January. Now we've bumped all the way up to December. So what does 3 rate drops this year mean to you, Mr. Gouget?
For me, I think like we had talked about briefly, and reiterated today, the market is, you're not going to wait till December to see this impact. You're already seeing this impact, and you're seeing the market move in anticipation of these. And so I think the long-awaited movement of mortgage rates in the downward direction is upon us. And I hesitate to say that because I feel like it's been a long 3 years of, this is somewhat temporary. We should see some rate relief pretty soon to, oh no, higher for longer. Oh, wait, you're going to see some rate relief. We're going to do a, 1.0 buy down and then rates are going to come down. And then wait, no, pause. It looks like, inflation is something that they really want to have totally under control. They're not just headed towards that 2% number. They want to see it. And Jerome Powell is slow moving, so much so that I think, he's got a bad reputation of, not moving fast enough in either direction. And so we, don't want to get ahead of ourselves. But I think that for those who are looking into the future, especially those who are buying in an environment where they're getting great deals on real estate because rates are higher and people are uncertain, that party's not going to last forever, in my opinion. But anybody who's got a plan of refinancing, restructuring a current mortgage in a way that benefits you, I think those times are definitely within sight. Not tomorrow, not next week, but if you look out 6, 9, 12 months, I think lower interest rates is something that you can pretty confidently depend on, barring any wild, of course, news that affects interest rates in a bad way.
Yeah, I think the other interesting takeaway here is looking at the history of the Fed decision making. We didn't get our first rate drop until September of 2024. And at that time, it was a 50 basis point drop. I mean, that was a double drop, essentially. And if the Fed's going to drop twice in one action, to me, that feels like too late. And I think that's just the entire nature of, this Fed board is action too late, reactionary instead of being on top of things in a way that's unhealthy. I mean, they waited way too long to start increasing rates. We didn't see, them come off of zero until March of 2022. Like we knew where inflation was going well before March of 2022. Like that's when we got that extra 25 bips. And then they had to move very, very quickly. And just kind of looking over the history, September, November, December last year, they did drop an entire 1 percentage point last year. It was not spaced out very well. It was not very even. It does not demonstrate, a knowledge of the market trajectories. And so I'm not surprised that we've got another year where, the last cut was December of 24. And now we're going to have to wait a full 9 months before seeing another one. It's just interesting because these 0.25% cuts don't necessarily do a whole lot in and of themselves to adjust, buying power, to adjust consumer activity. They're just trending in a direction that's going to make these short-term costs cheaper over a much longer term. It's not like it makes a direct and instant impact. So all that to say, we will see, but getting 3 rate cuts this year, dropping, 75 basis points compared to last year's 100 basis points, it's moving in the right direction. And it's going to get us a lot closer to that, that goal, that target rate of 2 to 2.25%. But let's talk about what really matters. What everyone really cares about is, this pretty chart is finally moving in a nice direction. It's the most beautiful that we've seen since the about the latter part of April. Matt, you want to do the honors and break this down for us a little bit?
Yeah. So, anybody who hasn't seen this is 30-year fixed rate mortgage, average across the nation. Keep in mind, this is probably perfect credit, paying a point and putting 30% down. But just so people have a general sense of where mortgage rates are at. I mean, I like Mortgage News Daily. I point a lot of people in the direction of that because this gives you a pretty rough idea of where rates are at. And 6.75 to 7% feels like where the market's been living really since, call it like February. And there's been some brief dips below 6.75. There's been some brief dips above 7%. Currently, I don't know if this is 6.71 or 6.7, where it's, at 6.72. but it's trending in the downward direction. What does that mean for you as a buyer? That means that, if you were currently looking at stuff that was, 699 a month ago, that's probably down to 675. Now, your scenario may be a different credit score. It may be investment property versus a primary. Whatever it is, you're probably down 0.25%, on the specific stuff you're looking at. And depending on loan size, that might be a few $100s a month. So, don't discount how much of an impact 0.25% interest rate will have. You go down 0.5% in mortgage rates, it is going to activate, in my opinion, a bunch of buyers who, just need the slightest of a push to get in the market. They're teeter-tottering between, yeah, I'd like to be in that school district. Yeah, I know we need more room because, besides the 2 kids, the 3 dogs we have, we're busting at the seams over here. Whatever people's scenario is, I know that there is a lot of kind of pent up sideline demand as mortgage rates come down. I think you've talked about it, Nash. I know I've talked about it. We may well have a very active fall and winter in a lot of markets across the U.S. Because it looks to be easing, on the affordability scale, because mortgage interest rates impact the most important part for consumers, which is what's my monthly payment. And so it's neat to see. I think the only warning I have for people is you don't want to necessarily wait until everybody and their mama and their mamas are out there shopping for real estate, because you don't want to shop in a competitive environment. In a lot of markets, the good news is you won't have to, because there's kind of a influx of inventory that's slowly built over the last couple months, while these buyers on the sidelines haven't been gobbling up inventory at the rates they have in the past. So, very long-winded way to say mortgage rates are coming down. It should and will, in my opinion, create a bunch of, just movement in a real estate market that's been, teeter-tottering on 4 million transactions a year, which is low, comparing it to some of the busiest years in this decade, a la 20 and 21, where we saw like 7 million transactions.
Yeah, I think, to sum up, Matt's ramble dance rant here, what I heard from you, my favorite stuff I heard from you is something I don't even know if you realize you said. You don't want to wait until you're competing with everyone, but you're not going to be competing with everyone. And I wanted to dissect that a little bit, because I think you're exactly right. And I think it's one of the key points and the takeaways here is, going from 699 to 675 may very well help you have a more affordable time. What it's not going to do is add another, 100,000 buyers in the market. It's not going to create a lot more inventory. Inventory is not going to be created with these 0.25%, 0.5%, even 0.75% movements. As long as we're in the sixes, we're going to see generally a balance like we have right now between buyers and sellers. What it does, funny enough, is it energizes and re-engages the real estate professionals, the realtors, the brokers, the loan officers, the mortgage brokers, coming out of the woodwork. Hey, rates are coming down. You should relocate your stuff. 0.25%, 0.5% could very well be the difference in a few $100s, like Matt said. It's only going to have an impact for the people who were already interested, who already were kind of on the fence, who had already looked at some things. So now, we should be re-engaging with those clients, because if they could make affordability work, if it looked like there was possibly something in their wheelhouse, now it's just better, and better is good. But what it is not going to create a 2021, even early 2022 frenzy where we see, hyper competitiveness in the market, because affordability is so low that people are willing to make some extra sacrifices to get there. I think once we get down to like the upper fives, maybe even low fives, we will see the market respond with some pressure on buyers. But it's hard to say exactly when that's going to happen. It's hard to say exactly how sellers are going to respond. But right now, we should see through the end of the year a continued softening in listing prices. We're going to see homes take a little while to sell, like they are currently, but we could see some more wins for buyers, but very small wins, not the kind of wins that you wait 4 months before looking, the kind of wins where you say, man, I'm glad I bought in fall of 2025 because, hey, I was able to get this home for this price instead of what it's selling for now.
Yeah, I had an interesting call this weekend, which I wanted to share here. Hasn't happened to me in the past, like cold reach out from real estate agents who have seen me talk about the power of selling it like a builder, offering a buy down to a buyer. And for me, that's a great sign for buyers. Sellers are out there looking for ways to incentivize you as a buyer to come off the fence and buy a house. And so take advantage of that as a buyer. If you're a buyer in this market, take what you can get, whether you're buying a new build or resale. This call demonstrated to me that even the resale homes and the sellers and the agents that are selling these resale homes have ideas and are going to offer incentive. The incentive that people like, oh, this is something that builder offers. I only get that if I buy a new build. No, you can get that on a resale home as well. You just, as a buyer, would have to know how to ask for it if it's not just being put out front and offered. But more and more, I'm seeing that, Nash, where sellers, to move the inventory that they own, are offering stuff that's really cool for buyers, because the buyers, they care about monthly payment. They care about the structure of, the debt, because 80+% of them are financing these homes. They're not buying them cash. And so as mortgage professionals, that's our job. Get in there and strategically structure something that makes sense for them. And yeah, as rates continue to trend down, more and more buyers are going to get interested. And to your point, it's going to really affect the ones that are already, quote unquote, in the game. Say, oh, okay, that works. Or maybe I go to 750 and I can get a lot more house, or I can get a better neighborhood versus the stuff I was looking at that was 700 to 725 on purchase price.
You're losing me with these California loan amounts, but I'm definitely with you on your final takeaway here. It's time to get creative, be strategic, work with a professional, and don't hesitate to ask for what you want. It's a good time to ask, and you don't get anything you don't ask for. So, hey, Let's take that creativity and go get some wins.
Let's do it. Thanks, buddy. Have a good week.
Awesome, man. Take care.